Hi guys, welcome back to Compound and Everything. Now, Tesla are of course profitable, but it might not be for the reasons you think. And I think that you might be surprised at how exactly that happened, because there are a lot of factors at play here, and this information doesn't seem to be common knowledge just yet anyway here on YouTube. Now, we aren't going to spend too long here going over the obvious. However, for those that missed it or lived under a rock for the last year, Tesla have been gaining some pretty significant traction in the marketplace, which resulted in their share price going from around $250 about a year ago to nearly $1,800 last week. So in this video, we are going to talk about one of the reasons they remain profitable in this most recent quarter. We'll also cover Amazon's most recent acquisition and if Elon should be concerned about it. And then we're going to go into valuations and if I'm buying Tesla or not right now. So we will kick things off by taking a quick look at Tesla's results. Firstly, this is the fourth quarter in a row that Tesla have reported profits. However, like I said, it's kind of unique how they make part of their income, which is actually the main reason I made this video. Some of you may not have heard of emission credits and regulatory credits. Well, in this case, companies like General Motors, who may not be as environmentally friendly, buy credits from Tesla to offset their kind of carbon footprint. So in a sense here, GM have contributed to the success of Tesla's most recent quarter, and in fact will continue to do so for the near future. Now, in the end, these credits netted Tesla $428 million worth of revenue, which is just shy of 8% of total revenue for the quarter, which was actually an increase also on the previous quarter, which was $111 million worth of credits. I really found this interesting, mainly for two reasons. Like I said, it's kind of ironic that GM are contributing to the operating profits of Tesla. But I also think it's a great position for Tesla to be in, where larger manufacturers are required to purchase credits from companies like Tesla. However, it might be worth keeping in mind here that without these credits, Tesla may not have been profitable this quarter. In saying that, it does look like this form of income is here to stay in the short term, so it's definitely something to keep an eye on moving forward. However, it's not something that I would be overly worried about if I was an investor right now in this disappearing next quarter and all of a sudden they're dipping into the negative side of things. Now, I'm not going to go too deep into the details quarter on quarter here. I mean, there are a lot of videos on YouTube already covering the releases from last night in much more depth than I will be. However, I think it is worth noting here that away from the credits that Tesla earned from companies like GM, they did perform very well, producing just over 82,000 vehicles and delivering just over 90,000. And yes, that is down 5% from the same quarter last year. However, I think all things taken into account when it comes to COVID and shutdowns and everything else that's been going on in the last sort of 6 months, they've done extremely well. Also, keep in mind here that some competitors are showing 30% or more declines over the same period. So yes, a big tick from me in this case for Tesla. Now, before I move on here, I need to ask you a little favor. In 13 days, this channel will be 4 months old. Now, I would absolutely love it if I could hit 10,000 subscribers in my first 4 months on the platform. Now, at the time of posting this video, I think we're roughly 800 subscribers away from hitting that target. So if you are enjoying the content and would like to support the channel, feel free to pop down there, press that subscribe button, and smash the like button as well. It really will go a long way in helping me to reach my massive milestone. So if you did just do that, thank you very much. I appreciate it. Anyway, moving on from Tesla's figures for now, I did hint at a little earlier in this video that there was actually a recent acquisition that I thought you guys might be interested in, which was Amazon purchasing Zoox. I think it's Zoox. Correct me in the comments or link me to the proper pronunciation. Now, this company is a self-driving car startup, and Amazon has recently purchased them for $1.2 billion. So I guess the main question here is, why are Amazon interested in getting into the car game, and should Tesla be worried? I mean, they already own pretty much everything and dominate every other space as well. So what's stopping them from doing the same here? Well, the answer comes in the form of a piece of software that Zoox were developing that enables sort of a computer to visually process information, theoretically more efficiently than the human eye can. Now, although it might seem like this is a play at Tesla's market share, I really don't think that's the case, at least in the short term here anyway. Amazon seem to be focused on using this software to advance their drone tech and possibly even their vehicle delivery network. I guess at this point, it's probably not something that I would be worried about if I was a shareholder. However, I would not be at all surprised to see Apple and Amazon entering this market, or entering Tesla's market, I guess we could say, in the near future. Now, if you guys are interested in a video of me sort of going over Zoox and the acquisition from Amazon a little bit more, then feel free to comment below and I'll definitely put something together for you guys if enough of you are interested. So this brings me to the slightly more controversial part of this video. We know that Tesla are doing an incredible job, not just at growing, but providing a more sustainable future for everybody. However, as investors, we have to learn to separate the two. You cannot bundle a company and its share price, as crazy as that sounds. You need to separate the two. On one hand, we have a company, and on the other hand, we have a set of books that do require an emotionless valuation. Now, that doesn't have to be a value-based proposition. It can be based on future earnings, possible growth outcomes, and so many other factors. However, you still have to create an even playing field that includes some kind of measuring stick. So in this case, let's take Elon's giant brain and futuristic company off the table for a second and just glance over the current valuation. We have a company producing roughly $24 billion a year in revenue, part of which is producing a very small operating profit. However, like I said, let's put all of our cards on the table here. So these are the facts. They've had fantastic growth. Negative figures are slowly but certainly improving, especially earnings per share and their net debt position. I mean, even book value has significantly increased over the last few years. However, where does that leave us right now, and what are we willing to pay for it? Currently, Tesla are trading 177 times earnings and 31 times book value. So firstly, let's just leave book value off the table for now. We're going to focus on earnings compared to the current share price, because what I need to establish here is if I'm willing to pay up front for something that I might not get back or might not even get a return back on for a very long time. I mean, even if Tesla continues this rate of growth, it could be well over 10 or 15 years, if not more, before their current valuation is representative of what could be an industry standard. And I think one of the biggest problems with this valuation at the moment is that it's not taking a few things into account. The first of which is competitors. And I'm not just talking about Nikola here. I mean, I think Tesla will have much bigger competitors in the future with much more capital behind them. And, you know, this might be a case of, well, look, valuations in the current automotive industry just are not representative of what they will be for someone like Tesla, which I do believe. I think that if we're looking at valuations now and going, well, maybe a 15 times or a 16 times earnings is fair for the automotive industry. Well, no, I don't think that's the same for Tesla. I think that would be absolutely false to say. However, they don't just create their own atmosphere in the future and then just live in this bubble of hyperinflation because they're the only ones. I mean, that has never happened in history. Somebody will always come and take some of that market share, and then somebody else is going to come and take some of that market share, and so on and so forth. And the problem at the moment is that we have some very large companies with the capital to do so. However, that is a discussion for another day. But my concern ultimately still remains here, which is that you can have any asset that produces income and you can estimate a value for it. Sometimes that asset might have more intrinsic worth to one person than another, and you might be willing to pay a little bit more for it, which is fine. And other times that asset is looking like it's going to produce a lot more income in the future. So you think, okay, I'll pay even more for that. But the question is then, how much? If I said to you, look, I have this business, it's returning 35% profit, I'd like you to pay me upfront for the asset and also the next 25 years of returns. Now, of course, I mean, that's a crazy thing for me to say, right? You wouldn't come to me and buy my business from me right now 25 years ahead of earnings. And yes, I guess this is somewhat of an oversimplification. However, this is what you're doing if you're buying Tesla right now. You're saying, I'm willing to pay for earnings that aren't going to be realized for decades. But the problem is that we do not know how profitable Tesla will be in 10 years. And we don't know what happens to this company short term if there were to be a real recession, which anybody can admit may be on the cards in the future. There are just so many factors at play here. Not only are you paying up front for future earnings, you're paying up front, putting it on the blackjack table and hoping to beat the dealer. And history shows us that buying great companies at historically high valuations normally ends in tears or a very long-term hold. Like I said a minute ago, you really have to learn to separate the two. And you can't get too caught up in this amazing idea and think it has endless amounts of value. I really do think that Tesla is an amazing company. I think they have a huge amount of growth ahead of them. And I honestly think that the other side of their business, which is the solar side, is massively underrated. Everybody is busy focusing on cars while there is a market that could be even bigger on the other side growing in the background. So yes, like I said earlier, great company, great products, great leader, and fantastic innovation. But if I'm looking at the books and the current valuation and how long it would take them to meet those expectations, well, I'm selling so fast that it makes Usain Bolt look slow. Now, I didn't have time to include Tesla's likely entry into the S&P 500 in this video. However, if that is something that you'd like to know more about, let me know and I'll throw together a dedicated video. Anyway, guys, thank you for watching. If you're enjoying the content, smash that like button and of course, feel free to subscribe and ding the notification bell. Thanks again for watching and I'll see you guys in the next episode. Cheers.